The stock market is currently closed as it is Sunday, December 14th, 2025. However, looking at the last active trading session from Friday, Tesla Inc., NASDAQ ticker symbol TSLA, closed at exactly $458.96 USD, registering a significant intraday gain of plus 12.09 USD, or 2.71%. When you look at a number like $458.96, the immediate expectation from the general public is that this is a ceiling, a point of resistance where traders take profits and the asset cools down. The narrative on social media and widely circulated financial blogs often suggests that after such a massive run-up from the 200s earlier in the year, the gas tank must be empty. They tell you that the valuation is stretched, the PE ratio is disconnected from reality, and that smart capital is rotating out. That is the expectation. A pullback is imminent because what goes up must come down. But the reality when you analyze the order flow and the institutional positioning from this past Friday tells a completely different story. The reality is that this 2.71% move wasn't a frenzy of retail traders chasing hype. It was a calculated, high-volume absorption of supply by institutional giants who are positioning themselves for something much larger in early 2026. We are not looking at a top, we are looking at a consolidation floor that is hardening into a launch pad. This discrepancy between the retail fear of heights and the institutional appetite for accumulation is where the opportunity lies, and it is exactly what we need to analyze today. Let's break down Friday's price action because it reveals the psychology of the market right now. The stock opened at $448.10, dipped briefly to a low of $441.67, and then spent the entire session grinding higher to close near the high of the day at $463.01, before settling at $458.96. This specific pattern, open low, close high, is a classic bullish engulfing signal on the daily chart. It signifies that every time sellers tried to push the price down, buyers stepped in more aggressively. Volume was heavy, clocking in at over 95 million shares, significantly above the average. When you see price increasing alongside volume, it confirms the strength of the trend. It means the move is supported by real capital, not just algorithmic noise. We are seeing a divergence between Tesla stock and the broader tech sector. While names like Nvidia stock have faced some cooling off as investors digest their massive gains, Tesla is catching a second wind. This rotation is critical to understand. For the better part of the last 2 years, Nvidia was the undisputed king of the AI trade. But as we close out 2025, capital is looking for the application layer of AI, companies that are not just building the chips, but are physically deploying AI in the real world. That is where Tesla sits, and that is why you are seeing this relentless bid under the stock price. This brings us to the core conflict, the identity crisis of the company in the eyes of the investor. If you treat Tesla purely as an automotive manufacturer, a price of $458.96 makes absolutely no sense. Traditional auto margins do not support a $1 trillion-plus valuation. However, the market is no longer pricing Tesla as a car company. The recent price action suggests a repricing event where the market is finally assigning tangible value to the Optimus humanoid robot program and the regulatory breakthroughs we are seeing for the cybercab. Throughout 2025, the skepticism was that these were science fiction projects, but as we head into 2026, the expectation has shifted. The market is now pricing in execution. This is a dangerous time for short sellers because the valuation argument falls apart when the underlying business model changes from selling hardware, cars, to selling labor, robots, and autonomy, software. Let's look at the broader market context. You have platforms like Schwab Intelligent Portfolios and Fidelity Wealth Management Services seeing record inflows into consumer discretionary and tech ETFs that hold heavy weightings of Tesla. This passive buying pressure acts as a buoyancy aid. Even if active managers want to sell, the sheer volume of passive 401k and IRA contributions flowing into funds like the SPY or QQQ forces these funds to buy more Tesla stock to maintain their weighting. It's a mechanical bid that provides a floor around the $440 level. Furthermore, if you use a Fidelity mobile app or an interactive broker's trading platform, you might have noticed the borrowing cost for shorting Tesla has remained elevated. This indicates that despite the high price, there is still a massive amount of skepticism, which ironically fuels the rally. When those skeptics are forced to cover their positions as the price breaks $460, it creates a feedback loop of buying, a short squeeze that can push the stock rapidly towards the $500 mark. Speaking of platforms, this is a good moment to pause and check the pulse of the retail investor. Comment below how many shares of Tesla stock you currently hold, or if you were waiting for a pullback to enter. It is always interesting to see if sentiment in the comments matches the bullishness we see on the charts. Now, we need to address the online investing landscape and how it affects this volatility. Retail investors using Robinhood stock trading apps or SoFi Invest have access to leverage and options that were previously reserved for professionals. The volume of call options expiring in January 2026 is staggering. This gamma exposure forces market makers, the banks and institutions facilitating these trades, to buy the underlying stock as the price rises to hedge their risk. It's a technical mechanic, but it explains why the moves in Tesla are so violent and directional. When the stock moves up 1%, market makers might have to buy millions of shares to stay neutral, pushing the stock up another 1%. This phenomenon is currently in full effect. We saw it on Friday. As the price crossed $455, the velocity of the move increased. That was not just sentiment, that was hedging. Let's switch gears to the fundamental reality that is driving this. The expectation was that EV demand would plateau. The reality is that while the broader EV market has softened, Tesla's margins have stabilized. They have successfully transitioned the narrative from how many cars can you sell to how profitable is your ecosystem. The energy division, specifically the Megapack deployment, is growing at a rate that dwarfs the automotive business. Energy storage is a high-margin, recurring revenue business that stabilizes the volatile cash flows from car sales. Investors using tools like Fidelity Brokerage or checking their Fidelity mutual funds performance are seeing that the energy sector is outperforming, and Tesla is quietly becoming a dominant energy utility company. This is the hidden value that the $458.96 price tag is starting to reflect. It's not just about the Cybertruck production ramp, which is proceeding better than the bears anticipated. It's about the fact that Tesla is becoming the primary infrastructure provider for the grid stability required by the AI boom. Data centers need power. Tesla stores power. It's a symbiotic relationship that the market is only just beginning to model correctly. Furthermore, we have to talk about the regulatory environment. The political shifts in late 2024 and throughout 2025 have created a tailwind for autonomous driving deregulation. The expectation was that a federal framework for robocabs would take a decade. The reality we are seeing now is that it might happen in the next 12 to 24 months. This timeline compression is what is driving the fear of missing out, or FOMO, among institutional investors. They can't afford to be underweight Tesla if the company effectively turns on a license to print revenue with a simplified national autonomous ride-hailing network. If you are managing a portfolio at a firm like Interactive Brokers or using a SoFi robo-advisor, you are programmed to chase growth, and right now, the growth story in large-cap tech is heavily skewing back towards Tesla. It's also vital to consider the broader macroeconomic picture. Inflation data has been sticky but manageable. hovering around that 2.7% mark. This has allowed the Federal Reserve to maintain a predictable interest rate path. For a long-duration asset like Tesla, where much of the company's value is tied to future cash flows from robots and software, stable interest rates are rocket fuel. When rates were spiking in 2022 and 2023, it crushed the present value of those future earnings. Now, with stability, those future earnings are worth more today. This is a textbook discounted cash flow adjustment that is repricing the stock higher. You might see headlines about inflation, but the bond market is calm, and the stock market loves calm. This stability encourages margin expansion, meaning investors are more willing to borrow against their portfolios on platforms like Robinhood Cash Management or Interactive Brokers accounts to buy more stock. Let's look at the technicals on the weekly time frame. Tesla has formed a massive cup and handle pattern over the last 3 years. The rim of this cup was the all-time high from 2021. We are currently challenging that rim. A breakout above the all-time highs would technically open the door to blue sky discovery, where there is no historical resistance. This is why the $460 to $480 zone is so critical. It